Hi, everyone. This is Hunter Satterfield from Kane Waters and Associates. I'm one of the partners here at Kane Waters, and this is your monthly market update for the month of May. We're going to start a new format, and I will be joined by two panelists. Those panelists are Brad Sanders, the Managing Director of Tectonic Advisors, and then Brian Bortz, also a partner here at Kane Waters with me, and also the head of our investment committee. So for the month of May, the returns for both the stock and bond market, the stock market was up right around 4.5% to 5% globally, depending upon what sector of stocks you're looking at. And then the bond market was up right around 0.5%. Now, Brad, I want to come to you first because it's very interesting to see a market in May that did this, coming right off another strong market in April. Yet, while the economy is beginning to reopen and we have some different sectors of the economy reopening, we're not necessarily back to pre-COVID levels. And so I guess the question to you, because we're getting this from a lot of clients, is, what's going on with the market and how it's not necessarily matching up with the economy specifically?
Yeah, what we have is a market that is it's completely dissociated itself from the economy for a variety of reasons, but mainly we learned after 2013 that when the Federal Reserve does quantitative easing, that props up asset prices. It's transmitted through the bond market. Most bonds are held by large pensions and tax deferred areas where money's not necessarily leaving, and even when people are panicking. And so if you artificially inflate bond prices, that money starts to flow out of bonds and into riskier assets like stocks. And so we have a market just coasting on that because the Fed's already done more quantitative easing in just the last 2 months than it did the entirety of the financial crisis. And they keep alluding to that more may be coming. So we have just a marketplace that's the market's doing one thing, but we have the worst economic data since the Great Depression. Now we have social and political unrest to layer onto that. And the market just doesn't seem to care. And it's just because it's trading off that liquidity injection right now rather than actual economic data.
Yeah, that's great. And I think, to kind of coincide with that, one of the interesting things that we're seeing is that we're seeing, while, maybe the S&P 500 and some of the other indices that we may see, are maybe only down 3, 4, 5% for the year, the average stock is still down right around 17% as of the end of May for the year. And we do still see some global equity indices that are down over 10%. Brian, can you share a little bit about, why, we're seeing the average stock still down significantly compared to maybe some of the, bigger domestic indices? Why is there a differentiation between those two?
Sure. Thanks, Hunter, for setting this up. And, the recovery that we're seeing right now has been incredibly narrow. And what I mean by that, I'll give you an example. The top three holdings in the S&P 500 right now are Microsoft, Apple, and Amazon. You just take those three holdings. 3 out of 500 names is 0.6% of the number of names that are out there, but they make up over 15% of the weighting of the index. And those three stocks are up almost 18%, about 11%, and about 34% for the year, which is completely different than the rest of the market and the rest of the economy. And they're driving that index way up relative to every other index that's out there. So, part of that has a lot to do with the fact that Brad mentioned earlier that the Fed gave this incredible injection of liquidity. There are, what I always tell my clients, there are 4 trillion reasons right now that the market has confidence. And that's the amount of liquidity that the Fed has injected so far.
Yeah, and to layer onto what Brian said about it being a narrow market, if you just take the S&P 500, once again, like he was alluding to, through the end of May, if you take the top 50 stocks, the biggest 50, I should say, the largest 50 companies, they're up almost 9% year to date. If you take the smallest 50 in that index, they're down almost 22%. So there's a 30% gap just based on size of the company. And it's just, that's where capital's flowed through. We can do a longer video arguing about whether or not that's correct. But the most expensive decile of the S&P 500 is trading at 45 times earnings. The bottom decile is trading at 10.7. So there's just going to be a give and take here. We expect volatility for the rest of the year to persist. We already have an election coming. We're not even thinking about that right now because of everything else that's going on. And we're just going to have, we think the backdrop is volatility, not the 10% days we saw in May, or excuse me, in March and early April. That's largely over because of the 4 trillion reasons Brian just mentioned. That's going to smooth that out. But 2 to 3% a day is going to be the norm as this market starts to figure it out. You know, you turn on TV and you hear people talking about a V-bottom recovery. Well, if you look at economic data, we're not going to have a V-bottom recovery. That's already evident. The market looks like a V-bottom recovery, so everybody points to that as evidence. But just tell me if this sounds like a V-bottom recovery. In January of this year, the company Zoom, which we're using right now, had the same market capitalization as United Airlines, fairly sizable companies. As of the end of May, Zoom is now bigger than all 5 of our major airlines combined. So when you talk about a V-bottom recovery, you can't have a V-bottom recovery and have an integral part to our economy like that be smaller than a teleconferencing software company. It just doesn't add up. So we're either going to have a new normal that the market's going to ferret out, which I think is pretty low, or I think capital allocation is going to happen at some point when we get light at the end of the tunnel, and you're going to see, you know, the market start to make a little bit more sense, and that's going to cause a tremendous amount of volatility. You're going to see a lot of the leadership change, and you're going to see a lot of money move around within the market, not necessarily come out of it, but just a lot of the debt getting reshuffled.
Yeah, and I think, you know, taking us even back to when, you know, Trump was first elected, I mean, even the night of that, we saw significant volatility, obviously, in the futures. And so I think, you know, certainly, you know, adding along with, you know, sort of the technical side of things that Brad said, you know, I think that volatility that's coming, and I think as investors, you know, we just came off this period in which we saw these huge days, these 7, these 8, these 9% swing days where it almost didn't make any sense. And I think what that does to us as investors is it creates in us some anxiety or angst about, you know, the certainty of our returns or what we should be expecting or what we should be doing. And so, Brian, just to kind of close us off, you know, for somebody like me that works directly with clients and is integral in sort of the investment committee process here at Kane Waters, can you speak a little bit, you know, with potential volatility coming into the elections and into the end of the year, you know, what should investors be focusing on right now, you know, fresh off of what we just saw, and what should their behavior look like right now?
Sure, good question, Hunter. I think the key for investors to remember is that risk management still matters. When you look at the market falling like it did in the end of March and has felt like a recovery since then, just remember that this is nothing more than really crazy volatility right now. And as Brad mentioned, we're going to see a lot more of that. The one thing that the market does not like is uncertainty. And in an election year, there's a tremendous amount of uncertainty. Who's going to control the House? Who's going to control the Senate? Who's going to control the White House? And given that uncertainty, the market has a lot of volatility. Add on to that civil unrest and other problems, you're going to have a lot of volatility in this economy and in this market. So downside protection and risk management matters tremendously. And that's really kind of what we try to focus on.
Yeah, that's great. And I think the only other thing that I think we, you know, specifically talk a lot about is just still having that long-term approach, especially depending upon, you know, what your investment horizon is and your investment strategy. So anyway, thank you guys for being with us today. And for all the viewers out there, we'll be back in front of you with a June market update at the end of this month. So thank you so much.